The financial industry is littered with jargon, and I think it's on purpose to help you keep needing those that are in the industry. I'm Mitch Hockenbury, and I'm going to explain, in plain English, what the top 2 financial terms Americans are least comfortable with their meaning. I was recently reading an article that referenced a study by YouGov gauging which financial terms Americans struggle with and those are they most comfortable. I found the list interesting and decided to help make the top 2 terms clear for you. Without further ado, coming in at number 1 is amortization. That is not too surprising. You may have some vague recollection of this term from when you purchased a home with a mortgage. The lender should have shown you an amortization table. This table is simply glanced at by most, which is too bad, because it contains a great deal of information and insight. Anyway, amortization is simply the spreading out of payments over different periods of time. Okay. Might not be clear still, so let's break this thing down Barney style. When you get a mortgage, the payment is the same over the period chosen, typically 15 and 30 years. The payment itself is made up of 2 things, interest payments and the principal payments. The interest payments is how much you are charged for borrowing the money. That is what the lender earns. The principal is the fancy term for the amount that you borrow. Even though your mortgage payment doesn't change, at the beginning of your repayment period, most of the payments is in the form of the interest payments. Only a small percentage of your payment goes towards the principal. This is why it takes 30 years to pay off the loan. Conversely, in the last years of your loan, most of the payment goes towards the principal and little towards the interest. Remember that amortization, I can hardly even say the word. Remember the amortization table I referenced earlier? That is where you can see year by year what is being paid towards principal and what is being paid towards interest. Amortization, spreading out payments over different periods of time. How much goes toward the principal, how much goes towards the interest each time a payment is made. Okay. The second term most people are least comfortable with is liquidity. Liquidity is a funny one because it can mean different things in different scenarios, but I want this to be clear for you. Liquidity is simply how fast a thing can be turned to cash without losing its value. Cash is king, they say. And any asset or thing you have that can be turned to cash quickly is liquid. In fact, some assets are more liquid than others. Let's run through a couple of examples here. Cash is most liquid. That makes sense. A stock is very liquid, but only if the markets are open. If it is a Sunday and you have a baseball card someone is willing to give you cash for versus a stock in your brokerage account, the baseball is more liquid, but most will tell you the opposite in a general sense. Why? Well, because of the last part of the definition, without losing its value. You see, to get top dollar on a baseball card might take a long time to obtain. A house isn't very liquid, a business even less so. Again, liquidity is how fast an asset can be converted to cash without losing its value. This term is important for your personal finances. Your emergency fund should be cash so it could be accessed quickly. You don't want your emergency fund tied up in Persian rugs. I hope this helps you understand amortization and liquidity. The third least comfortable word in finance is mutual fund, and I have a video on that to watch next. If you haven't subscribed to Personal Finance Made Clear YouTube channel, please do so. It really does help. I have additional resources on the definitions of amortization and liquidity, as well as references to the article at the official site of personalfinancemadeClear.com. Thanks for watching.